Is Chris Ward?
I've just emailed him to see.
Thank you. Good morning, everyone. My name is Adrian Axford. I'm the chairman of the Isle of Wight Pension Fund Committee. So welcome to our committee meeting today. I will welcome all who are either with us or who are watching us, and the members of the committee who are present. You should be able to see us on the screen. So we have, so far, the councillors are Barry Abraham, wave your hand, Barry. Debbie Andrea is not here yet. Vanessa Churchman, Councillor Andrew Garrett, Councillor Graham Perks, gives a wave, Graham, yes, and Mr. Steve Milford, who is the employee representative. Thank you, Steve. There are also a number of officers, board members and external representatives also in attendance.
And me.
Who's that? I'm sorry, Paul. Councillor Paul Fading is here.
Who's just arrived as well.
Oh, right. Is she on the thing yet?
She's got a camera.
Camera when she's plugged in.
Yes, she's there.
Right. Can I also introduce Councillor Debbie Andre? Welcome to the meeting, Debbie. Right. Thank you. A number of officers, board members and external representatives are also in attendance, but you won't see their pictures on the screen until they are invited to speak. And this is being held on screen because there is new legislation in place which allows meetings to be held remotely by whichever means are available to the local authority. And this one is Teams, isn't it? It's not Zoom, it's Teams. Please, can you switch off any mobile phones unless they are being used for the meeting? And all participants should be reminded to allow for a slight pause prior to speaking for technology to catch up and display correctly. And obviously, you need a moment to switch your microphone on. Please only speak when asked to do so. And remember to turn both your microphone and video for non-members of the committee before you speak. And if some items call for a vote, if we're noting something with an N, we don't need to take a vote on that. We actually vote on it. Vote with a V. We'll roll called. The clerk will call out all the names. And when your name is called, please confirm whether you wish to vote for, against, or abstain. It's not the opportunity to make an extra little speech saying why you want to do whichever one it is. And if the committee resolves to exclude the public and press, which is later on the agenda where we have some confidential matters, commercially confidential matters to discuss, in that case the live stream will be stopped. Will that move to the end of the meeting then, Joe? So that means that there's no point in waiting for us to come back because we won't come back. Sometimes people wait and then get cross. We don't want you to get cross. Right. Have I missed anything?
I don't think so.
In that case, can we move to the full agenda, please? The first item on the agenda is the minutes, which is pages 7 to 10 in the pack. I just had one query on that. You want me to detail it, Joe, or should you want to?
No, that's fine, Adrian, if you want to raise that issue.
This is page 7, item 26, second paragraph. You appreciate we're doing selection panels for two different items of new investment. One is for private debt manager and one is for infrastructure. So in the second paragraph, it should say, emphasis was placed on selection panels due to take place on the 6th of November 2020 and the 4th of December, where the panel would receive presentations from each private debt manager. And then we've got to add, and infrastructure
and infrastructure managers.
And infrastructure manager, respectively. Otherwise, it sounds as a private debt manager for each one. Subject to that amendment, I'm happy to accept these minutes. Is everyone happy to accept those, please? Vanessa, you've got your hand up. Vanessa? Is that a yes?
Sorry. Yes.
Or a yes? Anybody here else? I think you're supporting it, eh? Right, I will sign the minutes then. date is it? 25th of November. Lovely. Thank you very much, everyone. Sorry, I missed one item. We haven't got apologies. Have we had apologies from anybody, please? Are we all here? I think we're all here today, which is very good. Thank you, everyone, for all coming. Item 2 is declarations of interest. Do any members of the committee need to declare any interest they might have in matters on the agenda? Can you indicate on the chat bar if you wish to register that? No? Thank you. We will pass on from that then. And then we go to item 3, which is public question time. We have 15 minutes. Do we have any public questions, please?
No public questions have been received.
No public questions received. So we will move on. Item 4. To hear from the governance compliance activities, to hear from the Director of Finance and Section 151 Officer, which is Mr. Chris Ward, in respect of activities to improve the fund's level of compliance with standards of governance and administration. Can I ask whether Chris Ward is with us, please?
He is, Chair.
I am, Chair.
Good morning, Chris. Thank you for joining us. I think this item arose on the previous agenda because there were worries about the capacity of staff to deal with what have become more and more complex changes in the regulations. And I will pass over to Andrew Garrett to express the detailed point, please.
Thank you, Chair, because I did sort of lead off on this one at our last meeting. Mr. Ward, good morning. You'll have seen in the minutes, of course, that we noted the level of compliance that we have at the moment: 60% fully compliant, 36% partially compliant, the balance, of course, otherwise. What has concerned me over time is first of all, there is a desire and a need to be fully compliant in all areas. And that reflects upon this committee's work and ultimately the work that we do on behalf of the full council. That there are continuing and new pressures on officers to deliver the work for the committee that we need done. And in our discussion at the last meeting, it was explained that you, in your role, Mr. Ward, would be the person who could best explain to us what assessments you had made of the capacity of the organisation to deliver full compliance, and ideally you'll be able to say whether you feel that there is now a need to grow that capacity either over some time or just in the interim in order to bring us up to speed on things, and certainly give us an idea of the estimation you would feel that we would be very close to being fully compliant in all areas. 60% full compliance seems to me rather too low to be satisfied with. So I look forward to what you have to say.
Yeah, thank you, Councillor Garrett. I absolutely agree with everything that you've said. I think you're absolutely right. 60% compliance is not a place that the authority ought to be. I think you've also made the right point about levels of resources that we apply to the pension fund. Let's call it pension function. I think we had hoped that, you know, the peak of the work associated with the access arrangements and the new arrangements around governance and so forth would peter out over time. I think we've come to realise now that the standards of governance are much higher. The requirements of the regulator, I think, are and the high standards of the regulator are also increasing. And I think we're now in a position where we no longer believe that the current level of resources that we have for this work is sufficient. So just by way of background, and I'm sure you know this, we currently have about 1.4 FTEs that are dedicated to all of the arrangements around the pension function in relation to the remit that we take on. I think that we've whilst and rightly so, I appreciate your concern is solely around the resources applied to the pension function. But just in context, we are or have been for some time looking at the arrangements of the whole of the corporate finance and treasury function across the council, partly because we want to make sure that we've properly made ourselves ready for succession planning, and we have some vacancies that we have some vacancies at the moment. But as part of that reorganization, if you like, we do plan to almost segregate the pensions function from that corporate finance function. That's not to say that there won't be obviously support from the rest of the council. That clearly wouldn't be the case, but almost if you like, a ring fence around the pensions function. And our current thinking is that we need to increase the FTEs, or the full-time equivalent people that are devoted to that, from the current 1.4 to at least 2, possibly a bit more. That will obviously be a charge to the pension fund, but it feels to me as though it's a legitimate charge, and it's a charge associated with good governance. So you'll probably be pleased to hear that I've already spoken to Joe Thistlewood, and we do plan to make Joe 100% full-time on pension matters. We will have to work through what the balance of our 2+ FTEs look like. So we're going through a process, obviously with Joe at the moment, to look at what the design of those roles might be, particularly in relation to how we properly cater for the governance requirements of this committee. So I hope that gives you a flavour of where we are. I'm kind of anticipating the next question is likely to be, well, okay, what are your timescales? All I can say at the moment is we've started that work. There will be some recruitment involved, I am sure. So there's an HR process to go through in order to get that fully embedded. But I'd hope that we'd be in a position for the start of next financial year to say we now think that we've got a full complement, or we are close to having a full complement for the full-time individuals that need to be devoted to this activity. I'm happy to take any questions.
I've got Graham Perks who would like to make a point, please. Graham, can you switch your microphone on?
Yeah, it's not a lot to do with this. It's annoying that I take it that FTEs is full-time employees. I've worked that one out. And HR, I take it you're talking about human resources. It just annoys me, one, that you're talking about employees as FTEs, and they're all a cog in the wheel. So, and the other one is a lot of these abbreviations, albeit that you work with it day in, day out. I'm a publican. I don't use the computer as a way of life. So all these abbreviations, a lot of them don't mean anything to me. So can we please stop using them to the extent that we do use them at the moment, and actually use the words that they're meant for? Thank you.
Yeah, my apologies if I have slipped into the abbreviations. FTEs, it stands for full-time equivalents. So it's how many full-timers would we have? So sometimes when I say full-time equivalents. So if I say 1.5 full-time equivalents, obviously that's probably more likely to be 1 full-timer and 1 half-timer, as an example. But yeah, I will endeavour to not slip into abbreviations.
Well, thank you very much.
Debbie, would you like to make a point?
Thank you, Chairman. Can I just ask for clarification, Chris? You mentioned quite sensibly, I think, that this would be part of a wider restructure. Am I right in thinking of the sort of corporate finance team? Can you reassure us that we would be looking internally first, or I presume, or would there be some point at which we would look to fill the gaps externally? What would the actual process be for the restructure?
I mean, we are straying outside of the pensions function when I talk about this. So I'm really talking about the areas of the consolidation of the council statutory accounts, both the pension fund, actually, to be fair, both the pension fund and the rest of the council, the treasury management function, the pensions function, VAT, banking, many of those corporate finance related activities. Yeah, we will follow the normal process that we have for the council. Obviously, we wouldn't go away from that. So we'll follow the normal process. Everybody, if there are vacancies that arise or there are different positions, then everybody will have the opportunity to apply for those posts. Some of the posts will be very specialist, of course, because it's
going to be my point.
It's quite a niche area, really, and when you overlay the local government aspect, it becomes even more niche. But we need to be flexible around that in any event, and we need to be very clear about the skills that we want, because the knowledge and the experience can be developed over time.
I thank you. I think that was the reassurance that I was looking for, because in respect of the Pension Funds Committee, it is, as you've said, quite niche and it is specialist. So it's obviously our usual process would be to recruit internally, but we have to appreciate that either additional training would be needed, or we would need to look outside for the requisite skills in order to be effective in managing the pension fund function specifically. Thank you.
Thank you, Debbie. Are there any other points from the members of the committee? Andrew, would you like to come back in?
Yes, thank you, Chair, and through you, Chair, to Mr. Ward. I'm very grateful for obviously the consideration he's given to that. It's a significant increase from 1.4 full-time equivalent employees to 2.0 or above. So that obviously shows it was timely for such a review, and helpful for the committee to know just actually from our side of things how much the weight of work has increased as well. So it informs us as well in that sense. You were right in preempting my question on timing. These things do take time, particularly in the local government context and given the specialisms required. And I presume that we could get a light touch sort of update from committee to committee, but I would sort of expect around February time, whenever our committee is around that point, that we'd have something a bit more tangible to hear. But obviously you, Chair, have the primary responsibility to just keep the finger on the pulse otherwise. But again, my gratitude to Mr. Ward for that response and what it means for the work that we're going to be able to do from a member side, excuse me, a member side of this committee's work. Thank you.
Thank you, Andrew. Vanessa, did you have your hand up?
Yes, Chair, I do. I would like to know if we're going to make representations to MCHLG or what the Ministry, Housing, Local Government, etc., for added funding, because it is they who have added a tremendous workload to what were fairly well run pension funds. But of course, we've been dragged into the net of the whole pensions industry having to reorganise and all the bureaucracy coming down. So it's probably a forlorn hope, but I really feel that something should be sent to that to the Ministry of Housing, Local Government, etc., pointing out that the council is faced with another added cost. Thank you.
Perhaps we could have a brief comment from Joe on that.
Thank you, Chair. Oh, hold on, sorry, just 1 second. I realised you shouldn't have switched my microphone on. Apologies.
Yes, I think the issue becomes, Councillor Churchman, that the pension fund is separate from the council, and the pension fund is separately funded through employer contributions and investment returns. So we don't get, the pension fund doesn't get any grants or anything from central government to complete its administration. The issue becomes that the expectations of central government and the pensions regulator in terms of governance standards and administration standards are the same, regardless of whether the pension fund has 1,500 members or 15,000 or 150,000 members, or £600 million of assets, or £6 billion worth of assets. We have to comply to the best of our ability, regardless of what size of funds we are. So I don't think there is any additional funding available from central government. We can make representations in terms of, you know, potentially expectations of a smaller fund. However, it's down to each individual fund to manage its own workload effectively.
Thank you. For anybody who's watching on the outside, we have mentioned Jo Thistlewood a couple of times in the last few minutes. And first thing, as she's got her camera on, you can see, first of all, she's a lady, not a man, not Mr. Jo Thistlewood. Can be confusing sometimes. And can I say how pleased I am if she's going to be able to devote more of her time to the pension fund. She is an expert, has a lot of experience, and is a really hard worker, and it will be wonderful for her to be able to devote even more of her time to helping us. If I can just make a point on the funding of the pension fund, it really goes back to what Vanessa was just saying. Sometimes people say, well, any costs involved with the pension fund are charged to the pension fund. That is the clerical costs and so on, and staff costs. And so it doesn't affect the council budget. And that's true in the short term, because we have a council budget which is separate from those who work within the pensions area. But of course, in the immediate term, any increase in staff on the pension fund doesn't affect the full council budget. But of course, over a period of time, everything has to be paid for. We are always caught in the middle. The pension contributions by the employees are fixed centrally, and the pension benefits for the employees are fixed centrally. And so we have no control over those, and we have to make up any difference there is in the middle. So over a long term, and we do have to make up for any extra staffing costs. But I think this has arisen partly because some of the items which have come in recently, particularly the McLeod judgment, which is to do with age discrimination within different groups in pension funds across the country, not to do with us. They are just so complicated and so difficult to when they're backdated. It's so difficult to, in effect, retrofit the systems that it takes a huge amount of resources. I've got one more request to speak. It's from Barbara Milton, please. Could you turn on your microphone and your camera, please?
You're on mute, Barbara.
We're not hearing anything.
We still can't hear you.
Okay, is that better?
Yes.
Okay. I'd like to question whether it's appropriate to follow the council's HR recruitment policy in full, because the fund is separate. I think the chairman's just highlighted that there is a conflict of interest with the council as an employer and increasing the overheads of the fund, but it's my view that restricting it to any new positions internally first might limit the quality of an understanding of a pension fund in the recruitment process and any potential applications that come in.
Okay, is Chris Ward still with us?
Mm-hmm.
Could you take that point on board, please, Chris?
Yeah, of course. in any event, any appointment, it needs to be a suitable appointment. So if there are no suitable candidates, then an internal appointment wouldn't be made, and then we would be looking for an external appointment. But suffice to say that with any role, we need to be clear that the individual that is appointed is capable of taking on the role and being able to fulfill that role, even if it requires training. But that training should be that training and development should be over a reasonable period. So there'd have to be confidence that the training and development could be provided and assimilated over a reasonable period for the potential candidate to then be able to fulfill the role. So it's not a given that it would be an internal appointment. It would still be based on actual capability.
Okay.
Okay, Barbara?
Yeah.
I also have Steve Milford who would like to make a point on this. Steve?
Yeah, thank you, Chair, and thanks, Chris, for the reassurance of staffing on the sort of technical finance side. Of sort of I work alongside those people. I know them very well. I just wanted to go back to Councillor Garrett's original question. That's an assurance on the sort of technical finance side. Were you more concerned also about the resources within the pensions admin team itself, which is obviously a separate team and separately resourced?
Is that to me?
Well, I just wondered whether your question about staff resourcing and support was just about the technical finance team where Joe sits with the other Joe and a couple of others, or were you more concerned more widely about the pensions admin side and the support there as well?
Yeah, through you, Chair. My concern is always more broadly, but then on that specific item, it was about bringing us up to compliance. But I did note, I think, in what I said at the committee last time, that even when I first joined the committee, I recalled seeing in some form of risk assessment at that time there was comment around capacity of the team generally to deliver the committee's work. So I think there's always going to be something that will be on our mind, but presumably that has informed some of the consideration of what Mr. Ward has laid out for us today, and presumably also we as a committee will keep an eye on that, but also managers will as well in terms of their workload, or I would hope so. Thank you, Chair.
Thank you, Andrew. Okay, in which case I'd like to thank Chris Ward, our Director of Finance, for coming along to the meeting today and answering our queries, and we are given to understand that he will take on board the points that we've made, and we're very pleased with the progress so far in the announcement of extra staffing increase. So thank you very much, Chris Ward, for coming along today. Stunned him into silence.
Sorry, thank you, Chairman. Thank you very much. Goodbye.
Right, goodbye. Okay, that was item 4. Now we move on to item 5, which is the annual report and accounts. You will remember that there was a delay on this because of the COVID business. It was the first delay, and then the second delay was that the auditors couldn't sign off because they had a query on the full accounts, which has nothing to do with the pension fund, but delays us as well. So I will ask Joe Thistlewood to bring us up to date on the progress, please.
Thank you, Chairman. As Councillor Axford has just outlined, we did discuss the process for approval at the last committee meeting, and we noted that this was going to be subject to the outcome of the audit committee that was held on Monday this week for the council's accounts. At the audit committee, the audit partner Helen Thompson and the audit manager Jack Dunkley confirmed that they intended to issue an unqualified audit opinion on the pension fund accounts, and that they were able to close the audit of the pension fund. Subsequently to that meeting, we've had confirmation this morning that the auditors will be signing their audit opinions on Friday this week on both the councils and the pension fund accounts. So once we've got the formal signed audit certificates, the annual pension fund annual report and accounts will be published on the fund's website, and we can close the matter down. the information that's provided in the pack for today's meeting is a copy of the Pension Fund External Audit Results Report that was presented to the Audit Committee on Monday. It's a standard report. There's a lot of information in it. I don't propose to go through it in any great detail, but the positive note is there were no significant issues to bring to members' attention in respect of the audit of the pension fund accounts. I'm happy to take any questions, otherwise invite members to note this item on the agenda.
Yes, I sat through this at length at the Audit Committee meeting on Monday.
Mm-hmm.
So I hope that we won't go into too much detail today. And what Joe has said is in effect the situation. The auditors are happy that our accounts on the pensions are okay. So can we agree to note that, please? Thank you very much. That's noted. Thank you, Joe. Now we're looking at the next item, which is item 6, which is the private debt investment solution selection. Is that you again?
Yes.
And possibly Emma Garrett from Hymans as well.
Yeah.
Emma Garrett, you can see on the screen. Give us a wave, Emma. There we are.
David should appear as well. He seems to have dropped off.
Debbie, why are you
Leaving it.
You're not David.
Sorry, I was just waving at Emma to say hello.
Hello.
That's all right.
Just do a quick
All right,
summary,
go back to Joe.
We had a very interesting manager selection day on the 6th of November. I'd like to thank Hymans for facilitating the event and to the panel members who attended for their participation. We received 4 very good presentations with differing solutions to our private debt solution. In the end, members of the panel agreed that the Goldman Sachs solution was the most appropriate for the pension fund. Hymans have informally notified Goldman Sachs of their proposed appointment, subject to ratification by today's committee meeting. The confidential appendices attached to the report detail the presentation that was made by Goldman Sachs to the presentation panel, and also a report from Hymans confirming the suitability of the GSAM solution for our purposes. We can't go into too much detail on the appendices as they contain professional opinions, which are not for public consumption, but we're happy to take any questions on the process that was followed if necessary. We have received initial documentation for the account opening, which is being worked on behind the scenes. There's a 346-page fund document and a 71-page application form to be completed for this. We are working with colleagues in West Sussex who are appointing the same fund solution for their private debt solution in terms of getting legal opinion and legal advice on the documentation. The initial fund closure date is the 20th of December, so we're quite a tight deadline for the completion of this, and we anticipate the first investment to be drawn down in middle of January. Happy to take any questions from members or comments from members on the process, but otherwise I'd move the recommendation, formal recommendation in paragraph 26 of this report on page 46, that the committee agrees with selection.
Vanessa, would you like to speak?
Yes, just a couple of points. On page, wait a minute, page 10, one thing that did concern me slightly, Emma, slightly off-piste almost, out of 12 investment on the MBD investment committee, there's one lady out of 12 men, which really doesn't, anyway, that is just the comment. My next comment was on page 84, structure of the fund, Emma, it says Luxembourg non-regulated special limited partnership. Is this normal with all of these, I'm assuming this is a tax haven, but you know, again, I'm not very happy about it. But is this normal across all of these people?
Thanks.
Do you want to take it, Emma?
I was just going to say thanks, Vanessa, and noted on your diversity comments, and it's something we'll pick up with GSAM. It's quite a common legal structure for this type of fund, and the legal review that Joe is commissioning alongside West Sussex will likely look at that in more detail for suitability, but it is something that's pretty common with this type of fund.
Just one point on diversity as well, Vanessa. See, in the slide pack from Goldman's, they are trying to change, I would say, and improve the balance. And one of the initiatives mentioned on page 15 of their presentation, which is in the private pack, is their 10,000 Women initiative, and a target of 50% of women hires at analyst and associate level by 2021. So they are taking steps to try and address that issue.
Joe, if you could just remind us, I think Vanessa wants to speak again, but could you just remind, in a minute, could you remind the committee who served on that panel, please?
Yes.
Vanessa, have you still got your hand up? Are you okay?
Yes, Chairman, may I ask one other thing? What I also noticed was appendix, definition, legal disclaimers, risk factors, disclosure, which actually amounts to 1, 2, 3, 4, 5, 10 pages, 5 double-sided pages, and I certainly wasn't prepared to wade through them all. I would just like to double check, is this normal, and does somebody actually go, just where does it leave us legally? Okay.
Microphone, can you sit still, please?
Yes, Vanessa, there is always a lot of paperwork and legal disclaimers when you look at fund investment forms. The application form Joe mentioned is significantly long, but that will be reviewed in detail by the legal advisors.
Yeah,
and they will provide a report.
Yeah, and just the appendix 2, which is our kind of note on the suitability, draws out the key features and tries to have a much summarised version, Vanessa, of the key points in the fund, so we can provide you reassurance that we've looked at it from an investment perspective and we're happy that it's a suitable investment. And the legal review that Joe is coordinating with West Sussex will make sure that you've thoroughly tested the legal documentation on the investment as well.
Paul Brading, do you have your hand up?
Yes, Chairman. I just wanted to say thank you really to the 3 councillors that gave up their day to sit on the panel. I can imagine it was a really long, drawn-out day. So to yourself, Councillor Andre and Councillor Churchman, thank you for giving up your day for this important process to be followed through so diligently.
And Steve as well. Sorry, I was going to ask Joe to read out the roll of honour of those who spent the whole day grinding through. The only thing about it was that before we started, Hyman's, who'd drawn up the shortlist, said they'd be happy with any of the 4. Joe?
Yes, of course. So again, as the list is on page is in paragraph 5 on page 43 of the agenda pack, and the panel comprised councillors Andre, Axford, and Churchman, and the employee representative on the committee, Mr. Milford, as well as the Director of Finance, the Pension Fund and Treasury Management Accountant, and myself.
Thank you. And, I wouldn't say a good time was had by all, but it was very interesting. We learned a lot about it. If I can just sort of summarise. Earlier in the year, we decided that we would move away slightly from the more risky stocks and shares and invest in these 2 sections. And we said we would put 5% of our assets in each one of them. 5% doesn't sound very much, but when you've got 600 million to start with, 10% is 60 million and 5% is 30 million. So we're actually talking about shifting £30 million worth of value into this new item, and then the other item, which we haven't actually interviewed for yet, which is the infrastructure, will be another 30 million. So that's quite a lot of money, actually. Right, any more points on this item, please? In which case, do we have to vote on this?
Yes,
yes, we do. This is a decision, folks. We've got to decide something. So can you read out the, I think you already have done once, and you read out the recommendation?
Of course. The recommendation at paragraph 26 of the agenda pack is that the committee agrees the selection of the Goldman Sachs Merchant Banking Division Broad Street Local Partners number 4 fund for the delivery of the fund's private debt allocation.
Right, well, I will propose that from the chair. Could I have a seconder, please? Vanessa Churchman. And we will have a roll call by the officer. And could you please say what we're saying, yes or no? For, against, or abstain?
Councillor Abraham.
For.
Councillor Andre.
For.
Councillor Brady.
For.
Councillor Churchman.
For.
Councillor Garrett.
For.
Councillor Kirk.
For.
Councillor Axford.
For. You just so you get a vote on this?
He doesn't get a vote.
Oh, sorry about that, Steve. just out of interest, are you for? All right.
Yes, I was for, yes.
Good.
I would have been for if I was voting.
Bear with us. I hope you agree with. Lovely. Thank you very much, everybody. Right, and now we move on to item 7. And is this Joe again?
Yes, it's very, very quick.
This is very, very quick. This is for the second of these 2 selection processes.
Thank you, Chairman. This is just a reminder to members that the second of our manager selection days is happening on Friday, the 4th of December. So far, I have panel members confirmed. There's Councillor Andres, Axford, Churchman, and Garrett, and also then the Director of Finance, Pension Fund and Treasury Management Accountant, and myself. This event has 3 fund managers presenting, will be facilitated by Hymans Robertson again. Be a similar format to the one that was taken before, so we'll have 3 fund manager presentations at 10:30, 11:30 and 1 p.m, which will be a 30-minute presentation from each, 15-minute question and answer session, and then a 15-minute panel moderation session thereafter. We anticipate making a decision at the end of that day, and which will be ratified at the committee meeting on the 27th of January. We just ask members please to remember that date. I've just noticed on the agenda it says 6th of December, it should say 4th of December, that's my apologies.
So remember the 4th of December. Yeah. We're just noting that. Unless any member objects, we will note that. I don't see any objections. Thank you very much. And at least we've only got 3 candidates this time instead of 4. But I say we did actually, although it was a long day, we learned quite a lot about it the last time round, and I should be interested to see what the presentations are again. Right, let's move on to item 8, which is the scheme updates. We're going to receive an update on recent developments and legislative requirements, statutory guidance, and requirements of the pension regulator, which is the cause of what we had earlier on, saying we're overwhelmed with nitpicking changes to the regulations, which cause an awful lot of disruption in our ranks. So over to you, please, Joe.
Thank you, Chairman. Could I just remind members at this committee meeting, you are acting on behalf of the pension fund rather than respecting members of the pension fund or the employers of the pension fund. So your decision here today is concerned with the proper implementation of the regulations for the pension fund rather than consideration of whether you think the regulations are right or wrong or fair or otherwise. It's very important at this point because there are some quite contentious issues in the regulations behind the changes to the agendas. So this is one of the many key agenda items for pension funds and employers arising from government changes at the moment. Initial discussion from central government on restricting exit payments in public sector for public sector workers began in 2015-2016 to prevent fat cats leaving organisations with 6-figure payouts. Legislation on this bearing in mind the discussion started in 2015, was passed in quite a rush on the 17th of October 2020 and came into force on the 4th of November. This is one stage of the regulations. This is the regulations set by HM Treasury to restrict exit payments for public sector employees to £95,000. Exit payments, the exit package, should I say, includes statutory and other redundancy settlements, compensation agreements for redundancy, and any pension strain that is paid to the pension fund for the early release of benefits. For under existing LGPS regulations, any member who is aged over 55 and made redundant from their employment for business efficiency reasons is automatically entitled to full immediate payment of their pension unreduced. The pension fund is then allowed but not required to seek an exit strain payment from the employer, which is effectively making up for the lost contributions from that member and the early payment of benefits to that member for a longer period of time. And that's what the current regulations say, the LGPS. The current regulations do not allow for a partial payment of pension. It is either full and unreduced or completely reduced for actuarial purposes by actuarial valuation. So at the moment, and from the 4th of November until the local government pension scheme regulations are changed, administering authorities are forced to be either compliant with Treasury regulations or compliant with LGPS regulations, but cannot be compliant with both. The LGPS regulations are currently being consulted upon to amend them to allow partial reduction of pensions or for receipt of a lower pension strain cost. But until such time happens, as I've pointed out, pension funds will be in conflict with either Treasury or LGPS regulations. Scheme Advisory Board, the National Scheme Advisory Board, have been taking legal advice on this and have a dedicated page on their website, which is linked in the background papers to the report on your agenda. They have recommended a least worst situation for administering authorities, which is reliant on effectively complying with the HMT regulations and offering a fully actuarially reduced pension to the members at the time that they are made redundant. This is going to give rise to member challenge and is not the best situation for pension fund members to be in. And I must remind you, we are here talking about the situation for the fund. We can acknowledge that this is difficult for members, but we can't necessarily take that into account as we're determining our solution. So members will be required, will have to, or will be entitled, fully entitled to make a challenge to the treatment or the action that the pension fund has taken. And unfortunately, resolution can only come from this challenge until such time as the LGPS regulations are updated. Access has also taken legal advice on the advice offered by the Scheme Advisory Board, and the legal advice note from Access, if you bear with me, I just scroll down to my relevant page.
Can you just clarify that Access is the regional?
Access is our pension pooling. It's nothing to do with pension pooling, but we have worked collaboratively with those 11 funds to generate advice to save each of the 11 funds having to get their own legal advice. So we're getting economies of scale and getting consistent advice. The legal advice from Squire Patton Boggs from the on the advice given by the Scheme Advisory Board is that the Scheme Advisory Board is most suitable solution until greater clarity is achieved. It's about a 17-page legal opinion, which I can share with members. So effectively, what the Scheme Advisory Board is suggesting is that the pension fund pays an immediate but fully actuarially reduced pension, and that we recommend to our employers that they do not pay the equivalent of the capped strain cost to the member at this time, pending resolution of the queries. So there will be challenges, but the solution that is presented is least risk to the pension fund, because it will not incur additional cost that isn't funded, and hence have to fund it at a later date through valuation, employer contributions, and more risky investment returns. And also less risk to the employer, because they may be required subsequently to pay the pension strain cost to the fund. And if they've already paid it to the employee, they may have to seek to recover it from the employee or pay it twice. So what we're proposing, and what the council is, what we are recommending to the Pension Fund Committee, is that they adopt the recommendation of the Scheme Advisory Board and follow the least worst case, which is set out on paragraph 30 on page 94 of your committee paper pack. So we're noting the ongoing developments in respect of the implementation of the exit cap, and we can remove the subject to the outcome of its legal advice, because we have received that advice now, and the recommendation is that the council, the Isle of Wight Council Pension Fund, offers impacted members the opportunity to either take a deferred benefit or a fully actuarially reduced pension under LGPS Regulation 30.5, and that the fund recommends to its scheme employers to delay the payment of a cash alternative under Regulation 8 of the exit cap regulations. Very complicated. That was a very quick whistle-stop tour. I can only apologise for that, but this is a changing agenda item every day, to be honest. I'm happy to take any questions that members may have at this point.
Yes, Debbie has asked to speak.
Thank you, Chairman. Thank you for that very sort of clear guidance of where we stand as a committee. I think I have two questions, really. I know it's sort of a difficult thing to assess at the moment, but realistically, it seems to me as if we're in this sort of catch-22 situation at the moment, where we're almost damned if we do and damned if we don't. I'm really glad to hear that we are working with Access, because I think we have, that's, as you said, it's economies of scale and a much stronger voice. So my first question is, have we any idea of how long this interim period might be? And my second question is, obviously, in light of COVID, my concern would be, is the likelihood of redundancies going to be greater in our current climate? And also, who actually makes that decision to offer the redundancies? Because obviously those redundancies will impact upon our funds. So is you know, who actually makes that decision to offer the redundancies? Thank you.
Thank you, Councillor Andre. Those are very, very good questions. Firstly, the interim period of this this hiatus. As I said, the LGPS regulations, the revised LGPS regulations, which will be designed to implement the exit cap for the LGPS, are currently being consulted on by MHCLG, Ministry for Housing, Communities and Local Government, and the consultation closes on the 18th of December. So the legislation will not come into force until early in calendar year 2021. So we have a period of between, well, at least 2 months, possibly 5 months, possibly longer, depending on government debate time, etc., whilst we are going to be in this position. The likelihood of redundancies, the redundancy decision is made by the employer. So from our perspective, it will be the council or the other impacted employers through this legislation, which will be the town and parish councils and our academies. There is a suggestion that we might, as a fund, suggest to those employers that any redundancies are deferred until the LGPS regulations are in force. We cannot make the employers make that decision. Based on our initial review, we have spoken to the council as employer, and they have indicated that they do not have any significant redundancy programs in force at the moment. And for those that are in discussion, there are none, as far as we are aware at the moment, that would breach the 95k cap. So if the 95k cap is not breached, then everything continues as it is normally, and the member will be entitled to their full full unreduced pension as immediate. So the council will decide, but we are in negotiations with the council, and there is a working group that has been set up that's being chaired by the Director of Corporate Services, Claire Shand, to look at this information.
Thank you. I do note that actually part of the recommendation is that we delay the payment. So you've answered that one. So thank you.
And I have a request from Steve Milford to ask a question. Steve, would you like to ask a question?
Yeah, thank you, Chair. I note the recommendations from the pension fund point of view do make sense. I just wanted to ask for a couple of sort of clarifications, Joe. If by saying that we would go for deferred benefits for the employee, does that effectively mean they would get the full value of the pension settlement, but they would just get it at a later date? And in terms of the delaying of the cash alternative, whilst I can see that makes sense because you wouldn't want to pay an employee an amount of money then have to claw it back, but we are literally talking about a delay of a few months. We're not talking about any sort of more significant delay.
Yes, yes, both of those. If it's deferred pension, that would mean they would get their full benefit, but they would not get it until their normal retirement age. So they would wait until 65, 66, 67, whatever their normal retirement age is. And the delay to the payment of a cash alternative would literally be until there is either clarity in terms of both sets of legislation have been amended and a decision has been made, or clarity is achieved through the result of a challenge to another pension fund, most likely through the court system, which will not be a quick resolution, as members are aware of how long that sort of thing takes. So what we're trying to do is just cover that interim period where there is uncertainty or contradiction, I guess, between the legislation, so that we're not making matters worse for the member, the employer, or the fund. And as soon as the resolution is agreed and remedy is agreed to that, everything will be put into the correct position once that legislation is in place.
Okay, Steve. Thank you, Joe. In that case, can we move to the recommendation, please? The recommendation is on page 94 of your pack. I don't think we need to read it all out again. It's fairly clear there. Again, I will propose that from the chair. Could I have a seconder, please? Debbie? Debbie's seconding it. We will have a roll call for vote. You there, Barry?
Yeah, I've not heard any.
We couldn't hear, Chairman.
4.
Andre?
4.
Councillor Brading?
4.
Councillor Fletchman?
4.
Councillor Garrett?
4.
Councillor Kurtz?
4.
And Councillor Adam.
4. It's unanimous. unanimous. That's carried. Thank you very much, everyone. Right, that was item 8. Then we move on to item 9, which is the investment performance report up to the 30th of September. And I think for this, we're moving across, give Joe a little bit of a break. I'm speaking non-stop for just over an hour, virtually. And we'll invite Emma Garrett and David Walker from Hymans Robertson to lead on this, please.
Thanks, Chair. So item 9 is your formal quarterly investment monitoring report, and I will largely take it as read because in the committee meeting in October we did an up-to-date market background on what happened over Q3 and the fund's performance over that period. I'll just give you an update from the end of September to date. So markets have generally been pretty buoyant since the end of September. Equities are up both globally and the UK. UK equities are actually up higher than global equities for the first time in a long time, up around 8% since the end of September, with global equities up around 5% since the end of September. Markets have been really buoyed by the positive news of a coronavirus vaccine, which has benefited the medical sector within the UK particularly. Bonds are also up marginally, about 1.5%, and property capital values as well have remained broadly stable. So overall, that's a rosy picture for the assets of the pension scheme, and overall we expect your assets to have increased over that period, which brings your estimated funding level to 97% as of yesterday, so very close to that 100% and back in that target window of fully funded. Your total fund return is ahead of benchmark over the short and medium term. That's summarised on page 4 of the report, and you'll see your individual managers' underlying performance in there as well. Now, we go on to talk later today about your equity exposure in particular, so I won't dwell on that too much. You're also getting a presentation from Schroders, to which you have 2 mandates, 1 your property fund and 2 your fixed income, i.e. your corporate bond fund. Both of those have performed well and are ahead of benchmark over the short, medium and long term as well. Other couple of points to note are just updates from your managers that are on page 7 of this report or page 109 of the full report. All your managers are currently rated by our research team by either positive or preferred, which is our top and second top rating for those managers, and either good or adequate on a responsible investment basis where they are rated. Newton have had a number of personnel changes within their business, including changes to the CEO. We're broadly comfortable with them, but we do maintain their rating as on watch while we monitor the developments and see how they embed. Schroders have also had a number of personnel changes, although not quite as extensive as Newton, and none of them are causing us any concerns, so we are maintaining our rating as positive there, but that's something that perhaps Schroders will give an update on at their next meeting. And we discussed the headwinds facing UK property more generally at the last meeting as well, so Schroders will also give you an update on that. The rest of the report just goes into a little bit more detail on the specific funds and why they've performed the way they've performed over the quarter. I don't propose turning the pages on that, but I'm happy to take any questions from the committee on the performance to the end of September.
Are there any questions from the committee, please? I could just make a point, or a couple of points really. Oh, go on, Vanessa.
I can't hear you.
Thank you, Chair. Just that on page 6, fund perform. Oh no, sorry, wrong page. Wrong page. Go back. Sorry, on page 2, why we do so badly as the UK on the historic returns for world markets. Global was pretty good, but UK minus 16.6%. I don't understand that figure. Thank you.
So this is largely to do with the volatility we saw at the beginning of the year due to COVID-19. The UK was much more badly affected by what happened in markets than the rest of the world, and that's mainly to do with their large allocation to things like oil and gas and less reliance on technology. If you think about the US market, it's got big allocations to things like Amazon and Facebook, and those sorts of technology stocks did really well over the coronavirus pandemic, whereas the UK stock concentrations have not done so well, so it has significantly lagged the kind of global market. And we do go into that in a bit more detail in our equity performance review, and it talks about all the different sector and style differences, so we can cover that in a bit more detail then. But yes, the UK has lagged.
Sorry, we have a fire alarm going off in County Hall. I'm not sure what we do.
Meeting, I would think.
Yeah, run, I should imagine.
Yeah, I think we need to go.
Yeah.
For the time being, can we ask, Vanessa is the Vice Chairman of the committee. So, Vanessa, could you carry on please until we come back?
Yes, yes.
Are you happy to do that, Vanessa?
Yes, I'm here. I will carry on, Adrian.
You've got the paper.
Yeah. Right, as chair, Emma, you were in the middle of things. Would you like to continue, please?
All I wanted to point out, at the bottom right of the same page in that performance, you will see the return of oil and gas down -17.9%, and the UK economy has huge exposures to that sector, which is why it's suffered so badly this year, and is underweight to the stocks that have done well, which is why the UK has done particularly badly over the 12 months.
And just to, one of the other sectors there highlighted is financials as well, Emma. So just to note as well, committee, clearly the UK has a big financials weighting in their index, and again that's an area that, with a low interest rate environment, that the financial stocks have suffered over that period as well.
Thank you very much. Are there any other questions on this particular section of? Yes, carry on, Mr. Milford.
Thank you, Chair. I think it might just be a technical one. On page 6 of Hyman's reports, if you look at the table at the top and go to the bottom right-hand corner where it's got total for the 5-year relative, they've got a -0.7. I think perhaps the signs are the wrong way around. Shouldn't that be a positive figure there?
So the fund has returned 6.9% relative to the benchmark, which returned 7.7. So it's underperformed by 0.7% over the 5-year period.
I was just looking at in the column, the relative column, the only minus one is -0.6 against Majedi. All the others are positive, and I couldn't quite see why that would result in a -0.7 overall.
That can have both an impact of your manager returns, but also your strategic asset allocation. So where your assets have been relative to your strategy can make you perform over or under your benchmark. It's not just down to your active manager performance as well. So if you're underweight to something that has done particularly well, you will underperform relative to the benchmark, and vice versa.
Okay.
Any other questions before we move on? Do we need just to accept this report? Of course, I haven't got Joe here to ask.
There's no decisions, it's just for noting.
Yeah, so right, so just for noting. Thank you, Emma, that's great. So in which case we'll now go on to the investment manager presentation, but of course I'm not sure how they come on board because Joe is not now here.
I can see Joe's camp. Oh.
Hi, it's Jo Cook here. I've just had a conversation with Jo Thistlewood, and she's requested Vanessa or Councillor Churchman, if you'd be so kind as to adjourn the meeting until such time as Jo and Councillor Axford can come back into County Hall, if that's okay.
Right, that's fine. So what I suggest, ladies and gentlemen, is we adjourn for approximately 10 minutes. The time now being 11:10, we will resume at 11:20, which will give them both time to get downstairs to the car park and come back up again, hopefully. So
could I also ask everyone to
we introduced Schroders. So Jeff Day is the investment manager from our relationship manager from Schroders, I'll hand over to Jeff to introduce his team, and Megan, I think, Sarah is streaming the slides.
Great. Thank you very much indeed. It's very good to join you this morning. Thank you for the invitation. Just to say, however, we are very much looking forward to normality when we can meet in the council chambers in Newport again. I'm sure you share that desire as well. Just in terms of introductions, yes, my colleague Freya Petty will comment on the property portfolio. Today, you're invested in the Schroders UK Real Estate Fund. My colleague Michael Lake is going to comment on the fixed income investment you hold with Schroders in the Sterling Broad Market Fund. Just before handing over to Michael, who's going to present first, I mean, clearly Emma referred to this, the impact of the pandemic on the global economy has been very significant and harmful. It has also had an effect on fixed income and UK real estate markets in a number of different ways. I think, however, a key factor was the way in which the portfolios were structured coming into this crisis. And I think the positive news that we can report to you today is the fact that both of your investments have proved very resilient against this backdrop in relative terms. In other words, they've outperformed their benchmarks. Both have outperformed their benchmarks over 1, 3, and indeed 5 years, although in absolute terms, property markets have found the going more difficult over the last 12 months, as one might expect. I think more importantly is that we're very confident that both portfolios are structured appropriately given the outlook for markets as we see them at this time. But at that point, let me just hand over to my colleague Michael to talk about the fixed income portfolio.
Thank you very much, Jeff. As you were commenting, yes, this has been a challenging period for the global economy and in fact all aspects of life. But one thing it has done, one thing that we have observed is that it's created a positive environment for fixed income to continue to deliver returns for clients. Ultimately, fixed income is seen as being more of a quote-unquote safe haven asset or an area of safety within financial markets. And this has been one of the key drivers of fixed income performance this year, but it has been a bit more volatile in certain periods than we would affected. No market is truly immune from the impact of a global pandemic and the way in which markets then have to price that. As we go through, if there are any questions or if there's anything that I'm talking about that isn't clear, please do feel free to interrupt me and ask questions, but there will be time at the end if there is anything that you'd like to touch on. I believe everybody can see a copy of the slides. And so what I'll do is just go through them relatively briefly. I don't intend on labouring any particular point, but on the very first slide in our deck, in the deck, we talk about what is the objective of our global multi-sector team that manage the Sterling Broad Market Fund. This is to generate repeatable, transparent, and scalable active returns. What does this mean? It means we want to outperform the benchmark, and we want it to be very clear where we are making money and where we are losing money. The key things that we are going to do in order to generate positive returns in this portfolio above the benchmark is the fact that financial markets and fixed income markets in particular are affected by global forces. There isn't a single market that is truly isolated from any one particular part of the world. And what we also believe is that there are particular themes that will drive markets collectively over the course of a 12 and period and longer in certain situations. But we retain the strong conviction that our research and the research that we are doing into understanding driving markets will allow us to generate returns over time. And we're going to do this through both government and corporate bonds, both of which are in the benchmark for this portfolio. but we're also going to use the fact that we can have exposure not just to the UK, but to other markets around the world, and I'll talk about that later. Finally, I should also just like to mention that this is a team process. This team process is designed to take advantage of the fact that we have a broad range of skills, and for those who have the presentation in front of them, this is illustrated on slide number 2. Moving on to a summary of what has happened in the last 12 months, I think it is very clear to say that there is a before and after effect in some situations. There is a pre-COVID period and a post-COVID response. Now, this is detailed, again, for those who have the slides, on slide number 4. And what we do is, as I mentioned, we think about themes that are going to drive markets. At the beginning of 2020 and following on from the end of 2019, we believe that central banks around the world were determined to continue to support economic growth by keeping interest rates very low. We also felt that they would do more than that and take additional steps if markets were beginning to become nervous about the outlook for global growth. We also felt that global growth would, however, be positive, but it would be relatively weak overall, and this was a reason to remain relatively positive, but ever so keeping that level of caution in the portfolio as well. We also believe that government policy would be there to also support economic growth, but this support would be very marginal. We also believe that because of the fact that all fixed income markets are driven by global factors, that actually the evolution of the Chinese economy would also be a factor and would be a headwind to the global growth. That meant that when we came into the coronavirus period, we effectively had a position that was overweight corporate bonds with an allocation to government bonds to help protect the portfolio as well. Now, when we look back on the first quarter of this year, we will notice every single financial market had an incredibly difficult time, but government bonds hold up relatively well. Bonds underperformed. Following the coronavirus outbreak, what we saw was a very different set of themes driving markets. Whereas previously we thought that support from governments would only be very marginal, the size and scale of the healthcare crisis that we faced forced governments and central banks, and we see them as being two distinct and separate institutions, to take very, very meaningful and in most cases unprecedented action to continue to support economies.
Sorry, Michael, can I just you're breaking up a lot on your sound. Is there any other way you can do the sound, or could you speak a bit more slowly, please?
I will try and do a little bit of both. If I come closer, does that make it better?
I think so. It depends. Okay. Wait until you say a whole sentence.
Okay, I understand. I will slow down a little bit.
Thank you.
We also felt that, okay, I'll follow that suggestion and turn the camera off as well.
Let's try that.
Okay. We also felt that the role of central banks would go way beyond setting interest rates. We often hear the phrase quantitative easing being used very loosely. What does that mean from our perspective? It means pumping money into financial markets to support the smooth and continuous working of these markets overall. We also felt that the size and strength of various spending across the world would give opportunity to fixed income investors like ourselves. And when we move forward and we look at the performance of the portfolio on the following slide, on slide number 5, what we can see is that not only on a 1-year horizon has the portfolio outperformed and generated a positive absolute return, but on a year-to-date basis, despite the challenges to financial markets, we have continued to outperform. Where did we make money within the portfolio, or where did we make more money than the benchmark is probably a better way of describing it. That is detailed in the table below. We can see that government bonds and credit have both delivered a positive return. You will note that the return from corporate bonds is far lower than that from government bonds. It is important to remember that in the very first quarter of 2020, corporate bonds underperformed very significantly in response to the coronavirus outbreak. Effectively, financial markets looked at the companies that were issuing these corporate bonds, and with the entire global economy shutting down effectively, the question was, where on earth are these companies going to make money? As lockdown has eased through the middle of the year, and as we return to a certain amount of normality, people flocked back towards corporate bonds, and these have rebounded very strongly. But the main way in which the portfolio has made money this year has been through the allocation to government bonds. Now, the following slide, on slide number 7, illustrates where we have allocated to government bonds, effectively, which countries. And so the key along the bottom shows that we don't just allocate only to the UK, but these are positions relative to the benchmark, whereby we've used the flexibility in the portfolio to take advantage of US government bond markets. When we look back at this year, it's the US in a pure government bond market space that generated the greatest return relative to the UK or Europe, for example. Using that flexibility allowed us to generate some positive returns above the benchmark. Slide 8 illustrates the breakdown of our corporate bond exposure, and we effectively break this down into 2 main areas: investment grade and high yield. We also illustrate where we've held this investment grade or this high yield exposure either through cash bonds, i.e. physical assets, or through derivatives. And what this chart is illustrating is that we held our credit throughout the period. As we've seen, it did make a positive return, but we've also used, where it says investment grade derivatives, you will see these are on the negative side of the chart. That is us taking a protective position. That is us using the derivatives to protect the portfolio, and that has helped with volatility of returns over the course of this year. A very pertinent question now is, where do economies and financial markets go from here? And this is on slide number 10. Slide number 10 illustrates the output from our quarterly investment forum. Now, this quarterly investment forum brings together all of Schroders' resources within fixed income, and it challenges us to ask the difficult questions of one another. Where are we going to be able to make money for clients going forward? What are going to be the driving forces? And so the driving forces, we believe, are illustrated here in 4 themes. First theme is transition from central bank to government-led support allows traditionally pro-growth assets to perform. What does that mean? It means government spending is going to help support the economic recovery, and that it's going to be the areas of the market that are best adapted to benefit from this growth that are going to be the places that we need to allocate our risk. We do think that, as I mentioned, the global fixed income markets are interlinked, and the impact of the Chinese economy on the global stage should not be underestimated. The flexibility that China has to respond to further economic headwinds is reduced, and that will affect the path of growth across the globe. However, there are other bright spots. One of these bright spots is in Europe, where European governments are coming together to invest in the future of the European economy. And we think that will give advantage to Europe, and this is an area that we can then have greater confidence in investing in. We do, however, sound one note of caution, and this caution comes around global tensions, global geopolitical tensions, where, because of the fact that economic and social inequality is an extremely difficult topic for policymakers, politicians to grapple with, this could cause or have implications for financial markets that will increase the volatility, i.e. the swings between boom and bust in some situations. And we have to think about how we will protect the portfolio in that environment. So we see reasons to be positive, but we also see reasons to be slightly cautious. That is how we are going to continue to allocate and manage portfolios going forward. I have the portfolio positions later on in this pack, but I'm just going to pause now in case there are any questions.
Are there any questions from members of the committee? Perhaps you can move on then, please, Michael.
Nobody has.
No. Oh, you got your hand up, so I've just got into the habit of looking at the meeting chat.
Thank you. Yeah, thank you, Chairman. I do have a question actually on the slide that's currently up, and I do apologise if this is covered later on. But I think we have to mention, obviously we have, as I think you alluded to earlier, our UK investments and our European investments. What effect, because obviously we do have Brexit, what effect do we think that might have on our sort of both the UK and the European side of the investments?
When it comes to Brexit, and thinking about how this will affect the path of UK and European fixed income markets, we can't just think about Brexit in isolation. Is probably the point that I would make. Brexit will have an impact. I don't believe anybody can say exactly what the impact will be in numerical terms, in the same way that I would find it very difficult to state exactly what the impact of the pandemic has been on the long-term impact on the long-term growth of the United Kingdom. However, we can make some what I would describe as well-meaning assumptions, which is that we are coming out of a period in which the UK economy has been incredibly tested by this pandemic. That is going to remain for some time. And what does that mean? It means that the Bank of England will want to keep interest rates low They will want to keep what we describe as monetary conditions as accommodative, i.e. they'll want to do everything they can to help business support business. The fiscal expansion, i.e. government spending that we've seen in the past 6 to 9 months has been unprecedented. And that is going to, in our view, need to remain for some time. However, in the last few days, of course, we have heard some sounds from the Chancellor saying that we cannot continue to spend money forever. And there's been a suggestion that at some point in the future, we might need to consider a reduction in spending or indeed an increase in tax. I won't pretend that I can tell you when that is going to be, but what does that mean for bond markets? What does it mean for the fixed income portfolio? It means that there is still going to be a demand for UK bonds. There is still going to be that demand from domestic buyers, i.e. buyers within the UK, and to a certain extent, you may well get some foreign investment. But that foreign investment will also depend on how we as an economy bounce back from coronavirus and what the terms are for us when Brexit is finalised. A good example of this and the way in which the financial markets have been playing this in fixed income, and specifically within UK government bonds, is that when the outlook for the UK economy and the outlook for Brexit, a Brexit deal was better, UK yields, i.e. the yield that you get on a bond market, increased. Now, in practical terms, that means that people are more positive on the outlook for the United Kingdom. But when you had recently the announcement from Boris Johnson that we might not get a deal, it might be more difficult to secure the right type of deal for us, the response of the UK bond market was negative, effectively. Everybody started to feel much more uncertain. And I think you will get peaks and troughs like that as we go through the next 6 to 9 months, as we see peaks and troughs, as you get positive news coming through, whether that's a positive news on Brexit, whether that's further positive news on coronavirus and vaccinations, for example. Those will all be driving factors. And you'll see the same in Europe. However, within Europe, we think that the concerted effort that the European governments are making through what's called the EU Recovery Fund to support their economy will give a boost to European growth overall. And that is why we'd be positive on allocating to European assets at this time. I apologise, that's a long answer, but it is unfortunately quite a complicated question.
No, thank you very much for that detailed answer. So what I'm drawing out of that is that in the short term and possibly medium term, it's a question of almost holding our nerve in a way, and it will be the long term that will effectively guide our decisions. It's more going to affect, I would have thought, our long-term planning rather than the short and medium term.
I would say that's a very good way of summarising that. Essentially, over the end of this year,
we move on now.
Of course. Okay, excuse me. Yes.
Yeah, sorry, we've got a lot more on the agenda. I think we ought to move on, please. Is Jeff still there?
Should we turn to real estate then?
Yes, please.
All right, morning everyone. Hopefully you can hear me okay. And I think similarly to Michael, you've got the slides for the Schroeder UK Real Estate Fund update. So over the next 10 minutes or so, we're just going to canter through how the fund has performed over recent periods, our views on the market outlook, and how, of course, we're set up to continue that performance going forward. So if it's all right with you, if we make a start on slide 2 of the S2F deck, we set out the fund's performance in the top right-hand corner. As you can see, we've delivered outperformance over the MSCI UK Quarterly All Balanced Property Funds Index, which is SREF's official benchmark, over 3 months, 1 year, 3 years, 5 years, and 10 years, so full suite of the time periods there. And as I'll come on to talk about in a second, this outperformance is really as a result of the quality of SREF's assets, the resilience of the income return, and asset management achievements over the last few months. 2020, as Michael was saying, has obviously been a challenging market all round, and that's same goes for real estate. So COVID-19 triggering a downturn, fund suspensions due to material uncertainty applied to property valuations. We have now lifted that dealing suspension, and turning to the chart on the left-hand side of slide 2, that just gives you our outlook over the next couple of years. So in the next 3, we estimate at the all property level, so all sectors bundled into one, returns should be in the region of about -8% per annum for this year. But the good news is we're going to be seeing a return to positive total returns, averaging about 5% over the next 3 years. One quick thing to highlight is that there is going to be quite a lot of divergence in sector performance. So structural positioning of the fund is going to be absolutely key. Industrial and offices are leading the charge at the top of that chart, delivering about 9% per annum and 8% per annum respectively, while retail sector is lagging the pack at about 1% per annum. It's also worth noting that within the retail sector, we think there's going to be a bit of divergence. So warehouse capital values would probably bottom out before shopping centres, stabilising in 2022, whereas shopping centre cap values we think are going to fall over the next 3 years. So again, it comes down to that structural positioning. All right, if we hop on to slide 3, I just wanted to briefly remind you of a couple of team changes following press coverage in July. So Duncan Owen, our current global head of real estate, will be stepping down at the end of this year after his 30 years career and 10 successful years with Schroders. And he's going to be replaced by Sophie van Oosteren in January, who joined us from CBRE. And Sophie brings with her 25 years of experience. She's been CEO and CIO of EMEA for CBRE Global Investors, and I think her appointment really creates very exciting opportunities for us to continue the growth of our private asset capabilities with real estate at the heart of that, both internationally and across the risk return spectrum. And just quickly, the second point to note on this slide is that Jeff Burney, our SREF fund manager, is going to be taking maternity leave from Christmas. Rob Coslett and Amelia Tiernan, who you can see there highlighted in the central blue box, are going to be assuming the roles of acting fund manager and SREF investment manager respectively. Rob is reporting into Nick Montgomery, who's our head of UK real estate, and provides oversight support to the team alongside the investment committee. But I think Rob's really well placed to pick up the reins while Jess is temporarily absent, given he's worked on major projects across SREF's portfolio since he joined the business about 5 years ago in 2015. And I think it's also worth emphasising this slide really demonstrates, just simply given the number of heads on the page, that SREF's performance is really attributable to the collective efforts of our wider team, and that includes our sector specialist asset managers, the rigour of the investment committee, robust business planning processes, etc. So we really know where that future performance will be coming from and feel comfortable that we can execute going into 2021. All right, slide 4 provides you with an overview of the fund's current positioning. So from a sector perspective, on the right-hand side, you can see the fund continues to maintain a structural underweight position to retail to enhance our defensive qualities. And then we've got strategic focus with an overweight to secure long-income office assets, alongside those in key London submarkets and regional centres where we're particularly targeting growing technology and life sciences occupiers, where we see a lot of growth coming forward in those sectors and a demographic underwrite to income. So going forward, there will be a continued emphasis on the proactive management of our industrial allocations in particular, and sustainable investment in that sector to support outperformance. But I would stress sustainable investment, given yields are obviously very keen in that sector at present, given its flavour of the month, or flavour of the last couple of years, I should say. And if you look at the income breakdown on the left-hand side of the slide, I just wanted to draw your attention to the resilience of the fund's income return as really underpinned total return performance through 3 main characteristics. Firstly, the strength of that income return, and that's been driven by diversification across 717 different tenants. You can see in the little pie chart at the top there, and also the robust nature of the covenants of those tenants. So the UK government is our current largest occupier. They account for about 9% of contractual rent per annum. And this is set to increase over the next couple of years, actually to about 20% of contractual income, given we completed a second letting earlier this year at Ruskin Square, our regeneration project in Croydon, to the UK government, to the Secretary of State for Housing Committee and Local Government, and that actually abuts HMRC exposure we've got there already. Secondly, that high quality income is secured for a longer period of time than benchmark peers, with an unexpected time to break of 9.1 years versus benchmark of 7.2. So higher quality income tied up for longer. And then thirdly, the affordability of the fund's income has really proved critical in the current environment, with revenue pressures on tenants to sustaining income streams. But it also has capacity for growth, and that's demonstrated in the reversion yield. You can see there a high 5.7% just on the right hand side. And what that indicates is the running yield of the portfolio, what it would be if assets today were let at market rents versus the current running yield of 4.1%. So built-in room for growth there. Just moving on quickly to our strategic priorities on the next slide, slide 5. These are really setting out how we're going to be driving performance going forward. So hopefully, as you're aware, we work very closely with our research team to identify the most apposite themes which are going to enable us to capitalise on market mispricing, asset-specific opportunities going forward. And then firstly, at the top there, number one is the discipline of divesting out of assets where the business plan is completed. We've achieved peak prices and we're anticipating those assets to underperform moving forwards. We then reinvest that capital from disposals into opportunities delivering a higher income return, with future opportunities hopefully as well to generate capital value growth. Secondly, as a team, we are highly active in our asset management approach and very focused on executing individual business plans at asset level to drive performance. So on the right hand side of this slide, I've set out our near-term pipeline over the next 3 years of identified opportunities we'll be taking forward and how much income we're seeking to generate from those opportunities, so you can get a quantifiable measure. Thirdly, there are significant existing opportunities within SREF's portfolio, and that really comes back to the quality of the assets we were talking about a couple of slides ago, to deliver enhanced returns, and that's without, crucially, having to go to the market where pricing can be keen in favoured sectors and cause frictional drag. And then lastly, I think our consistent approach to sustainable investment and enhancing the environmental performance of assets is really seeing performance at the moment through buildings generating increased tenant demand, which in turn drives value and ultimately feeds through, of course, to increased capital values over the long term. So in the next couple of slides, I just quickly want to set out a couple of examples to bring this to life a bit more about how we're putting these strategic objectives into practice across the portfolio. So if you hop onto slide 6, we announced last month the sale of this asset, Electra Business Park, in October. So this is a prime industrial asset located in the shadows of Canary Wharf, so not too far from where I'm currently sat speaking to you at the moment on the Isle of Dogs. And we sold this asset to Segro for about 133 million, and that reflected quite a record net initial yield of 2.58%. And this sold for 33 million above the 100 million valuation. So net of top ups and sale costs, we crystallised 32.7 million of profit for the fund, and that was reflected in our NAV price at the start of November. So what you saw over the last month was a pickup in the NAV of 1.5%, and that's primarily attributable to this sale. So top performer, why did we sell it? It's delivered a total return for the fund of about 12% per annum since its development in 2002. And the sale, as we talked about on the last slide, was really driven by our strategy to recycle lower yielding assets where the business plan is completed and which are anticipated to underperform moving forward, and then reinvest that money at higher returns. So Electra now commands the top rents all across London locations for comparable unit sizes. Downside risk, of course, is that further rental growth wouldn't be viable for occupiers, particularly in the current climate. And in order for the asset to outperform against the achieved sale price headlines, rents will need to grow by about 13% per annum over the next 5 years. And that was what the buyers were underwriting. By comparison, we think industrial rents in London are actually going to be growing at around 2.5 to 5% per annum. So it just shows you how bullish the buyers were being. Hopping on to slide 7, this exemplifies how we're recycling that capital into higher yielding assets. So in September, we exchanged contracts to acquire 1 Cambridge Square, which is a prime freehold development site just adjacent to North Cambridge Station. Freehold is very rare indeed in Cambridge, so really rare opportunity for us to get our hands on. And it's the first phase of a 34-acre mixed-use regeneration scheme, which is being developed out by Brookgate. We're providing 45 million of funding for 100,000 square foot, 8-storey prime office development with leading sustainability credentials. And this comes back to what I was talking about creating future opportunities. We've also got a couple of preemption rights and options to be a first mover on 2 subsequent phases. So really exciting for us. We're going to be PCing, I think, late 2022. We're on site at the moment. So it's about 24 months lead time, and the GDV, when we finish, the gross development value will be about 56 million, and this is going to generate an income yield of 6.25%. So we're going from 2.58% to 6.25%. Really exciting move for the fund. And then just lastly from me, because I'm conscious of your time, I just quickly wanted to emphasise what we're doing on the sustainability side, because I do appreciate this is increasingly important for all our clients, but particularly you guys and local government. On slide 8, I've tried to sort of summarise for you quite a complicated sustainability framework and how we approach the integration of responsible investment. It's really integral to how we go about buying assets, managing them, engaging with our occupiers, and we believe that real estate with impact should really deliver sort of the holy trilogy of the following 3. So enhanced long-term returns for our clients, obviously. We want to contribute to our tenants' business performance through facilitating well-being, modern ways of working, and we also, of course, want to deliver positive impacts to communities, the environment, and society for long term. So what we've done is trying to go above and beyond just the integration of ESG into our decision-making philosophy and our management approach, but actually target a positive impact. So proactively take action, spend money to improve the social and environmental outcomes. We've established 4 pillars of impact in order to do that, which are the 4 bubbles you can see on the left-hand side, which surround that circular framework. And they reference the UN Sustainable Development Goals and fall into the buckets of impact, people, place, planet, and prosperity. And then around that, we use that framework to identify very particular and specific targets at platform and fund level. And you can see on the right-hand side, we've set out a couple of the headline progress marks. Last point on this slide is GRESB, the Global Real Estate Sustainable Benchmark, which we've participated in as a business since 2011, so nearly a decade now. And that is the global sustainability benchmark for real assets, and quite a good threshold, therefore, for measuring our performance versus peers. SREF itself has achieved green stars for the last 6 years running now, and I should be publishing GRESB results for the fund's 2020 submission very shortly towards the end of this week. But we have confidentially received 3 green stars once again, so really amazing performance from the team. And a very quick example, just to round up, of how we put that into practice on the next slide, slide 9. This is the exciting deal I mentioned we did earlier in the year with the UK government. So Ruskin Square is a 9-acre mixed-use town centre regen scheme, which is just adjacent to East Croydon Station. Brilliant transport links, and we secured planning consent on 2 million square feet of office, residential and restaurant space and mixed amenity. We did the first office building in, 2016 now, and we let that to HMRC on a 25-year lease. And again, that had a BREEAM excellent rating, which testifies to its sustainability credentials. And then on building number 2, we agreed an agreement for lease with the UK government in March this year in the midst of COVID market impact on a further 300,000 square feet and another 25-year index-linked lease, so building in that secure, inflation-linked, liability matching type credentials to the fund's income return. This is going to be a pilot, this scheme, of the Better Buildings Partnership led Design for Performance initiative, which aims to tackle the performance gap between building design and how it actually operates in practice. So we'll be importing, if you like, the Australian energy rating system, which is called NABERS, a bit like the soap opera, to the UK. And the general principle of that is to optimise performance in use, as I said. So that's going to involve management at a very detailed level of things like embodied carbon, all-electric energy strategy, rainwater harvesting, high-performance facade, green roof, cycle racks, showers, modular structural design to minimise embodied carbon in construction, photovoltaics, fresh air volumes, those kind of things, but all taking that into account. Again, this will be BREEAM excellent. It'll be well enabled, which is a leading tool for advancing health and wellbeing in buildings globally. And we'll be focusing on sustainability in the procurement process. So hopefully that whistle-stop tour gives you an idea of how we're approaching fund performance and the ongoing management of our assets in the round. And I'll be happy to take any questions if you've got time. Thank you.
We are short of time, but are there any quick questions for Freya, please? Vanessa?
Two quick ones in a way. Are Croydon Council involved in any of this lot? Because I understand they've virtually been declared bankrupt. And do you have an interest in the buildings they still occupy further down in the town, which used to home the immigration office, etc.? Because I wonder what's going to happen to them. But my most important question is, where does China fit into all these scenarios? Thank you.
So I'll tackle those quickly in turn, if you don't mind. Firstly, with Croydon Council, we are obviously collaborating with them very much so in our development project. The 9 acres we own is jointly with Stanhope, the developer. It's 50-50 joint venture. So we don't have any financial exposure, if you like. It's purely SRF's investment, and we don't have to worry about their bankruptcy. It's just we're working with them on affordable provision, amenity, their requirements, and the lettings we've done are to central government, so HMRC and Secretary of State for housing. The ownership, I'm not entirely sure of which buildings they occupy, whether it's inside or outside our ownership, so I can check that and come back to you if you don't mind. But our exposure, as I mentioned at the moment, is central government buildings. And in terms of the impact of China, SRF is obviously a UK-focused portfolio. All of our investment is therefore domestic, and the bulk of our investor base is similarly domestic, though, as you know, we have been making significant efforts over the last couple of years to branch out. I think our main concern would be from an economic perspective, and as Michael touched upon right now, is a challenging period, primarily because of the impact from COVID on markets, hindering liquidity, hindering transactions, obviously triggering recession. But actually, we've got a slightly rosy outlook over the next couple of years. I think 2020 will be tricky, but we are going to start to see a Nike swoosh-shaped recovery over the next couple of years. So there should be a significant pickup in funds NAV over 2021 and 2022 as that bounces back. And we will continue in the meantime to diversify the fund's investor base to the greatest extent possible and grow the fund.
Fine. Okay then. Thank you very much. So I'd like to thank Freya and Michael and Jeff for joining us today. I know there's a lot to go through, and we're always trying to rush you through everything. I know I don't really do you justice, but life, we still have a lot of things to do. And as you can see from the meeting chat, the members of our committee are grateful for the comprehensive update which you've provided us with today. So thank you for joining us, and thank you for that.
Thank you for inviting us.
Thank you very much.
Thank you very much.
Appreciate your questions. Bye. Goodbye.
Cheers. Bye.
Goodbye. So we'll move on quickly on to item 11. If there are any comments you want to make about any of these items which have been circulated, Jo?
I think, Chairman, the only thing I would point out is item O, that's right at the bottom of the second page, is the invitation to the Access Virtual Investor Day on the 17th of December. The virtual event, it runs from 1 o'clock until 3 p.m. It's really discussing the role of Link, Northern Trust and their relationship to the fund and how the pool fits in with our investment strategy. So I would recommend that members attend that if they can. Other than that, nothing else.
Thank you. Sorry, I should have asked with the previous item 10, the presentation should be noted. Are you all happy that we note that? And this one that Jo has just done, can we note the items as well? Vanessa's got your hand up.
Just a quick question. I've got it in the diary for the 17th, but will we get an invitation, or how will that happen, please, Jo? Thank you.
Invitations should have been issued. If the joining instructions aren't there, then I'll make sure that they are coming out as soon as possible. So as soon as I get them, I'll share them around.
So Paul, did you have your hand up, or were you just agreeing to everything?
I was just agreeing to everything, Adrian.
First. That was item 11. We've noted that. Thank you. Coming on to item 12, which is the members' question time. Do we have anything?
No members' questions have been received.
No members' questions received in writing. We'll move on from that. We now have some commercially confidential items coming along, so there is a motion to exclude the public and press. I will move that. Could I have a seconder, please? Debbie seconded that. We have to roll call.
Councillor Abraham.
Yes, thumbs up.
Yeah, 4.
Andre.
4.
Councillor Brading.
4.
Councillor Churchman.
Vanessa. 4. Yes.
Councillor Garrett.
4.
Councillor Perks.
4.
Councillor Axford.
4.
No,
Thank you, everybody. In which case we will close the public part of the meeting. I have down on my agenda here that I should be adjourning for a 10-minute break. I'm